Here's a stat most of the financial industry doesn't want you to see. Over 90% of actively managed funds underperform their benchmarks over 15 years, even before we account for taxes. And the longer you stretch that timeline, the worse it gets. It's all in a report from S&P Dow Jones Indices. And once you see this data, you'll probably never look at investing the same way again. Today, we're digging into a report called the SPIVA Scorecard, short for S&P Indices versus Active. It's published semi-annually and is one of the most robust studies available comparing actively managed funds to simple benchmark indices. The idea is pretty straightforward. Take a universe of actively managed funds, say large cap growth, and compare each to an index that mirrors its investment style. It's apples to apples. The goal, to see if active managers, despite all of the marketing, research, teams, and fees, actually deliver better results than the benchmarks that they aim to beat. Now, it's worth noting this report is published by Dow Jones Indices, which is, of course, in the business of creating benchmarks. So yes, you could say this is kind of like a butcher putting out a report that says meat is good for you. But here's the thing, this methodology has been independently examined by academic researchers, and it holds up. It's widely considered one of the most credible and quoted data sets in the debate over active versus passive investing. Now, if you're thinking about what investment strategy best fits your retirement plan, active management can seem incredibly appealing to some. After all, in most areas of life, action is often rewarded. Taking initiative usually moves us closer to our goals. In contrast, passive investing is often defined by simplicity. Buy a basic index fund like the S&P 500 and hold it for the long term. But that raises a fair question. Why would we just blindly own the 500 largest companies in America? An active manager might say, why not own the 500 best companies instead of just the 500 biggest? And let's be honest, there are definitely some laggards in the group of 500. You can see this on this chart. Returns across different sectors of the S&P 500 can vary quite dramatically. During this period, communication services outperformed while materials lagged. And so the logic goes, if we can simply pick the winners and avoid the losers, we should come out way ahead over time. There's also the belief that passive investing just forces you to sit through the emotional roller coaster of market volatility, whereas active management can smooth out the ride. And even if active funds deliver the same return as a passive one, if it does so with less volatility, isn't that a real benefit to investors, especially those in retirement? These are compelling narratives. They feel intuitive. And for many investors, they sound like common sense. After all, if we can bring skill, research, and judgment to the table, shouldn't that deliver better results? Now, we could debate these narratives in theory all day, but I think the data speaks much louder than any narrative can. Let's dig into one of the broader tables in the SPIVA report. This table compares funds in each category to their closest benchmark, looking at performance over multiple timeframes from 1 year all the way out to 20 years. What you are seeing here is the percentage of funds that underperformed their benchmark. If we zero in on the 1 year column, the data is quite mixed. For example, in large cap growth, a staggering 92% of funds underperformed their benchmark over the last year. That's pretty rough. But scroll down to small cap growth and we see that it's almost the opposite. Only 23% underperform. So at a glance, it might seem that active management can add value in certain categories during certain timeframes. But now watch what happens as your eyes shift to the right, towards the longer time horizons. Once we move to 15 and 20-year periods, the picture becomes dramatically more one-sided. Across every equity category, more than 80% of funds underperform their benchmarks, and in many cases, it's well over 90%. So those compelling narratives that we discussed earlier, well, the data seems to challenge them quite loudly. But in fairness, let's try to steelman the case for active management. One critique is that this table only shows raw returns, but part of the case for active management is about delivering a smoother ride, reducing volatility and helping investors stay the course. This data doesn't really address that. Second, the underperformance metric is binary. If a fund trails the benchmark by even 0.01%, it's counted as an underperformance. And while this is technically true, that kind of microscopic gap isn't really meaningful to most investors. So to be thorough, let's bring in some additional data that addresses those critiques head on. First, let's talk about the effect size. How much active funds underperform or outperform by? What you're seeing here is the annualized return over different timeframes from 1 year all the way out to 20 years. Benchmark returns are highlighted in blue, while average returns of actively managed funds are shown in white. This data is also asset weighted, meaning larger, more popular funds carry more weight in these averages. So this gives us a pretty fair sense of what the typical investor is actually experiencing. Now, take a look at the 15-year time frame. The S&P 500 has returned just under 14% annually over that period. Meanwhile, actively managed large cap funds, which are in the same category, average only 12.35%, a gap of more than 1.5% per year. Now, that might not sound like much in a single year, but compounded over a 15 or 20-year retirement horizon, it adds up to a huge difference in total wealth. And again, we're still looking at raw performance, however, not adjusting for any volatility or risk. But even before we get there, the magnitude of this underperformance is quite striking. One reason this gap exists: costs. It's not uncommon to see active funds come in with expense ratios around 0.75% per year. Well, broad market index funds might cost 0.05% per year. So right out of the gates, active funds have a clear built-in hurdle that they have to overcome just to keep pace. But here's the critical point. The underperformance we see here isn't just about higher fees. Even after accounting for costs, the effect size of underperformance is still there, which suggests something deeper at play than just pricing. Now let's move into risk-adjusted returns. We're still looking at the same underperformance data here as before, but now we're adding in another variable or another layer: risk. What risk-adjusted performance means is this: if a fund delivers a similar return to the benchmark, but does so with less volatility, it gets credit for that lower risk. So now we're comparing not just on how much a fund returns, but how consistently it gets there, or how smooth of a ride it takes in getting there. On the left-hand side of the screen, you're seeing US equity categories over a 20-year period. And rather than weakening the case for index investing, this lens actually makes it even more lopsided in favor of passive strategies. On the right side, we're looking at international equity categories. Now, there are a few outliers with international small caps, for instance. But let's keep perspective here. Underperformance in this category still happens roughly 2/3 of the time. That's hardly a win. And just to be thorough, let's expand this view beyond stocks. What about bonds? The data holds up there as well. Across most bond categories, passive investing still dominates. That said, we do see slightly more opportunity in certain corners of the bond market, particularly in high yield, general bond funds, and global income funds. But again, don't lose the plot here. Even in these areas, underperformance is still the norm, not the exception. The Overton window may have shifted slightly, but we're still seeing 60 to 70% of active funds fail to outperform. Now let's shift gears to a critical consideration for retirees: tax efficiency, especially when it comes to certain account types. In accounts like traditional IRAs or Roth IRAs, taxes don't impact investment growth during the accumulation phase. So active versus passive isn't really a tax issue here. But in brokerage or taxable accounts, taxes can be a real drag on performance. Typically, when an active fund manager buys or sells inside of the fund, that triggers capital gains, which are passed on to you, the investor, near year end. It doesn't matter that you owned the fund and didn't change that ownership. Your manager changed what the fund owns. So while you're sitting tight, your fund may be generating a tax bill behind the scenes. As a rule of thumb, anytime that you pay taxes during the growth phase, you are giving up future compounding. And this is where active management has yet another hurdle to overcome. On the left-hand side of the screen, I'm showing the average effect size of underperformance before and after taxes. Yes, even index funds in a taxable account come with some kind of tax cost, but that cost is minimal compared to the 2 to 4% annual underperformance that we see from the median actively managed fund. On the right-hand side, we're looking again at the percentage of underperformance post-tax. And again, the picture gets worse for active funds. Taxes don't just reduce your return, they increase your odds of falling behind. And if you're relying on a portfolio to support a decades-long retirement, those odds really matter. Next, I want to quickly dig into some more hidden data inside of this report and bring it into the spotlight because it can matter greatly as we talk about your retirement investing strategy. One thing I really appreciate about this report is it digs into items like survivorship bias. So when looking at a mutual fund manager, they may have marketing material that appears to say the exact opposite of what this SPIVA report says. They might show you a specific fund that has been around for a while and does in fact show certain timeframes of outperformance. Have a healthy level of skepticism when analyzing these marketing materials, as they often don't show the whole picture. This chart shows the percentage of actively managed funds that have actually survived over a 20-year period of time. And what you'll notice is roughly 50 to 65% of funds don't ever make it to the finish line. They were closed, merged, or simply shut down, often because of poor performance. So when you look at historical returns from active funds, it's important to remember the worst performers are often missing from the story. There's one more insight here that's especially important for retirement investors: style drift. When you build a portfolio with specific allocations, say having this much in large cap growth and this much in large cap value, you're doing that intentionally. It's designed to manage risk and provide diversified exposure. But many active fund managers struggle to stay true to their original investing style. I've seen this anecdotally, especially with dividend strategies. For example, value stocks are typically the highest dividend payers, but value has underperformed growth for much of the past 15 years. So what happens? Dividend managers start stretching their definition, pulling in growth stocks to keep performance up. Now you've got a fund that says it's doing one thing, but really it's doing something completely different. This creates a real risk. Your portfolio might seem diversified on paper, but over time it drifts into concentration. And you won't even know it until it's too late. Worse, now you have to actively manage your active manager just to maintain your plan. So after all this data, what exactly should we be taking away? First, it's clear that inaction, simply holding a low-cost index fund, has data overwhelmingly on its side. This doesn't mean there's no benefit to active management. The data isn't 100 to 0. But for anyone thinking probabilistically, the stories we hear about skill, timing, and selection just don't hold up across the full landscape. Second, some might look at this and say, okay, I'm just going to buy the S&P 500 and skip the planner altogether. Now, this is an oversimplified takeaway. Even if active funds underperform, there is still immense value in financial planning, portfolio design, tax strategy, and behavioral guidance. Knowing that index investing is effective is one thing. Knowing which indexes to combine, how to allocate across different account types, and how to adapt that plan over time, that's a whole different level of value. Finally, remember this: the financial industry is full of polished marketing and persuasive narratives. But when you have good data and the right questions, you can cut through a lot of that noise and focus on what actually works for your retirement. Now, if you're wondering how to improve your investment portfolio, even as a passive or index investor, I've put together 7 clear, practical ideas that you or your advisor can use to do exactly that. Click right here to watch that video. And as always, you don't need more money, you need a better plan. I look forward to seeing you in the next video.